Hello everyone. Welcome to Investing with Sachin. First of all, wishing you a happy, healthy and a prosperous 2026 ahead. Today, I have picked up a retail gem from a high street. A lot many of you would know about it. The business is none other than Greg's PLC, the baker on the high street. They are a baker. They are food to go convenience retailer. They are available across UK, I would say 2700, 2800 stores. It's easy to access, easy to reach. They are known for value, convenience, and the brand. If you look at last 12 months, what has happened? They were at 31 pounds in January. They have fallen back to 16, 17 pound range. 40% fall. One can say it's a massive fall. Has the business changed? Right? It has been a high growth, high compounder business over the last 10-15 years. It's a darling of stock market in that retail food segment. But it's been going currently valued more like a low growth value stock. And that could be one of the reasons why it appeared on my scanner. Currently, the overall market cap is $1.7 billion and the recent share price is 1680p. The key question for us to answer today is this a permanent derating or is it a temporary overreaction, and what does it mean for all of us when we look forward? What are their plans? How they're looking to scale the business? Is it reached a saturation stage? When we look at that, I would still say there is a lot of growth remaining. They have 150 net store opening plan as they look forward. So when you look at the product range, they are expanding into cold drinks, cold iced coffees. I know my daughter's Bill. She been possibly having a couple of cold coffees every day. So that's the trend. That's a Gen Z trend, and I think they're looking to catch that trend. I think it's very apt for the business model. They are expanding bake at home range via retail chain. So if you're visiting Tesco, if you're visiting Iceland, if you're visiting some other retailers, you might find Greg's product available to pick up. So that's another avenue of growth via product. And there are other number of innovation they're bringing in products. If you look at format side, they're coming into various formats. One is a drive-through format, which is quite imminent for them to drive the growth. They're also looking at bit-size Greg's, very small, ultra convenience format, low cost to run, but you drive similar revenue and a better profitability than other stores. They're all on delivery channels. I think today not being on a delivery channel will harm your business. So when you look at their business model, they're available across Overeats and other partners. And one of the growth driver for them is 10% plus growth into the evening meal segment. So all in all, there are a number of, I would say, catalysts which are driving business forward in a right trajectory. Let's look at the quality of metrics on a financial front. What does it say? How does it look? They are a high ROE business, 25% plus ROE. PBT margins till recently used to be 10%. Off late, it's been dropped to 8%. Revenue growth, 3 to 6% is going on even after difficulties they're facing. And it's a strong brand with a decent value perception and possibly ability to pass some of the cost to the customer if it proves to be difficult to drive volume growth. What actually gone wrong in 2025? Right. So especially there are two things. One is June, July, exceptionally hot weather doesn't bode well with Greg's. During the hot weather, people don't prefer hot food, hot meals. As a result of it, Greg's had a slide in sales, which led to the profit warning. Obviously, we all know consumer confidence in last 6 months has been low as well. So that would have had a subtle impact as well. So as a result of it, they came back with a profit warning, and which took a toll on the share price, taking it down from 31 odd levels to 14, 15 pounds. If you look at the other aspects, right, it's very difficult to replicate a business. It's end-to-end supply chain, and the retail economy is what they drive. It's a food supply chain, quite agile, quite fast, quite resilient, and not only the ambient but also the frozen. So managing that kind of a scale, supply chain, the distribution network is not easy to replicate. So the business model will stay intact. Uh, Over the years, it has been a low debt company, net cash company. Of late, it has got a $2.5 million of debt, which is £1 million of debt, which is nothing compared to the market cap and other numbers. So all along, they've been self-funding the growth, cash generative in nature. What are the other important factors to know of? Well, last 3-4 years, I think CapEx has been higher. They've been expanding capacity, adding capacity in Midlands. They have added 2 big facilities for manufacturing, for distribution. They will go on stream pretty soon, next 1 to 2 months. So the bigger CapEx cycle is behind them, so, which is very good if somebody is looking forward to invest from here onwards, because the CapEx will drop circa 100 million year on year and maybe more after that, which can give them 6 to 7% additional cash flexibility to maneuver, either distribute via special dividends, buybacks, and whatnot. So I know it's a depressed valuation. It might take 1 to 3 years to recover, but while you wait, you have 4% dividend yield. In my mind, it's a risk free because it's 2x covered. Lot of cash going to be generated over the next few years. So with the special dividends, that 4% yield could be even more. And over the period, I expect the business to be re-rated from 11 to 13 PE to 15 to 16 PE, not necessarily historical, but even 15 to 16 PE. On those parameters, I expect it to trade back to 2300 to 2600 levels come January 28. I expect earning per share to be 150 to 155 PE, assuming it trades at slight premium than where it is today by 15-17x. So when you look at what are the risks ahead, as with any retail business, they are faced with the labor inflation, they are faced with the government changes on the minimum wages, the NI implications, they are faced with the food inflation challenges. But these are the challenges they as a business has lived through the time. And I'm sure there are good enough mitigation strategies in place to overcome those. One of the recent ones is the weather implications and what does it do to the business. I think with the diversion to the newer formats, bit size, drive through, the more focus on cold coffees, cold drinks, I believe they will have good enough mitigation in place to drive business in a steadier fashion. I would again like to clarify, this is no means an investment advice. It's for study purposes, for you to analyze, understand how business operates, how market values them, how rating, derating happens, and take these examples in learnings. Do your own research if you want to invest, where you want to invest. Manage it via your own risk profile, financial advisors as you go through these investments. Thank you for watching my video. If you have found it interesting, please like it, subscribe my channel, and stay tuned for the next one coming in a week's time. See you soon. Bye bye.